Hi everyone, and thanks for joining us for our latest webinar on the changing energy market. I'm Tom Paul, and I'm a Senior Costing and Risk Analyst at E.ON. In today's webinar, I'll be firstly giving a brief introduction on what the main third-party costs are. Secondly, I'll be giving an overview of some of the latest industry changes emerging out of Ofgem's targeted charging review, the modification CMP 308, and the new fixed charge bandings for electricity network costs. Lastly, I'll give a summary of what the new RIIO-2 network price control period is and what costs will be affected by it. My colleague Sam Hill will then be reflecting over the events in the energy markets in 2020 and then looking ahead to what changes may be in store for 2021. First of all, a brief summary of the industry third-party costs E.ON incurs. These fall under three main categories. In the top left, there are the network costs. These charges pay for the upkeep of the pipes and wires that transport gas and electricity around the country. Second of all, on the top right, we have the policy costs. These are charges that pay for government schemes which subsidise the generation of renewable and low carbon electricity. And finally, at the bottom, we have the system costs. These charges recover the costs of ensuring the balance between generation and demand in the electricity system is maintained at all times. Today's webinar, we will be mainly focused on the changes coming in the electricity network costs to NUOS and DUOS, and the electricity system balancing costs for SUOS. Ofgem's Targeted Charging Review, or TCR, has sought to change the electricity network and system balancing charges to ensure they are fair and proportionate. Some of the main changes from a pre-TCR to a post-TCR world are summarised here. Pre-TCR, TNUoS charges were solely recovered from consumers based on their demand. For half-hourly settled sites, this was based on their demand during the winter triad periods, and for non-half-hourly sites, this was via their evening demand throughout the year. Post-TCR, only a small proportion of the TNUoS charges are now to be recovered this way, with a new banded fixed annual charge now the main way of recovering these costs. For DUOS, a similar change will occur. Currently, the DUOS charges are mostly recovered through different rates based on consumers' time of use and their location, known as the red, amber and green periods. A small proportion of the costs are recovered through a single fixed charge. Post-TCR, more of the costs will be recovered through a fixed charge, and this will now be structured into bands, aligned with TNUoS, and is the same wherever the site is located. Both these changes are expected to be implemented from April 2022. For the electricity system balancing costs for SUOS, pre-TCR, around half the costs were recovered from demand, which was net of embedded generation. From April 2021 onwards, this benefit will be removed from embedded generators, with BSUOS being charged on the gross import demand instead. A further change to BSUOS charging is currently under consideration, CMP 308. This modification would lead to removing the requirement for all generators to pay BSUOS costs, resulting in the costs being recovered from demand only. This is currently expected to be effective in April 2023. Now a bit of detail on the new bandings for the fixed charges for TNUoS and DUOS. The table on the right shows the new bandings in which each site will be allocated into and will determine the level of fixed charge they will pay. For domestic and UMS, there is one charging band only. Non-domestic sites are split into four types, each with four bands. Firstly, low voltage with no maximum import capacity. These sites are non-half-hourly settled and are allocated a band based on their average of their net annual consumption over the past 2 years. Half-hourly settled sites are split into low, high and extra high voltage. These sites are then allocated a band based on their agreed capacity level, or KVA. The definition of a site has now changed from the original Ofgem decision. A site is now defined by the consumer's connection agreement and not by the tax definition. And to confirm, where a site has multiple MPANs, then the charge will only be applied once. Sites will stay in the same band until April 2026, and sites can only move bands if its consumption or capacity has changed by over 50%. The next planned reallocation of bands is due in April 2024, and this will use the average of the consumption from the previous 2 years for allocation. So, what does this mean for consumers? For TNUoS, the value of triad avoidance and load reduction from evening peak has reduced dramatically, and some sites will only have a fixed charge, eliminating this potential value completely. We'll see the biggest rises in costs in half-hourly sites which have a high agreed capacity but low overall consumption. For duos, unit rates over the year should decrease by a flat rate, with some green consumption periods set to be zero in some regions. Sites near the edges of bands will see the biggest difference in overall costs, while sites towards the middle of bands should see little overall cost change. In BSUOS, the move to higher gross demand should see a lower rate than would have been seen otherwise for the period April to 2021 to March 2023. However, in April 2023, it's likely that the CMP 3308 modification will nearly double the BSUOS rates, with the move to charging on demand only. However, it is expected that the wholesale market price for electricity will reduce as a result, as the cost to generators is removed. Now, moving on to the RIIO-2 price control. To protect consumers, the gas and electricity network operator revenues are controlled by Ofgem. The controls are built around the RIIO model, which bases the operator revenues around performance incentives, innovative projects, and output activities. The second RIIO price control period will start this April and will run for 5 years. The final determinations of the expenditure allowed for RIIO-2 were published in December, with Ofgem seeking to reduce the rates of return seen in RIIO-1. The revenue set for this RIIO-2 period will affect the costs for BSUOS, TNUoS, and the gas network charges, NTS and LTZ. So in summary, TCR will introduce a fixed banded charge for electricity network costs from April 2022, whilst removing the benefit for embedded generations from BSUOS in April 2021. In April 2023, BSUOS is likely to move to charging on demand only due to CMP 308. And finally, Ofgem has now set the initial base expenditure for RIIO-2 price control period, affecting network costs for the period April 21 to March 26. And now over to Sam for the next part of the webinar.
Cool, thanks Tom. Thank you very much. Hi there everybody. My name's Sam Hill. I'm a sales trader on the sales trading desk at E.ON. Today we're just going to have a little look back at the previous year and have an outlook as well, looking ahead to 2021 and potentially some of the drivers we're expecting to see. Just moving on to the first slide. Apologies in advance, but we are going to start by taking a look back at the previous year. As you're all aware, 2020 has been quite a year. The usual subtleties of gas and power fundamentals have overwhelmingly been affected by the progression of COVID-19. It's highlighted frailties in the economies, as well as frailties in economies as well as national gas and power networks. As significant a driver as it has been, we have seen other trends developing in the commodity complex that will impact businesses into 2021 and beyond. To highlight the impact of the virus, the graph below shows the front-month rolling MBP gas contract over the last 4 years. As you can see, 2020 in yellow at the bottom has traded at a significant discount to the previous years, especially over the first 3 quarters, in line with the development of the virus. The year started off trading low actually. During the winter 19 period, the threat of cooler temperature forecasts never really transpired. With higher temperatures and lower prices, we saw gas storage facilities injecting, anticipating cooler weather in Q1 20. Well, we got to 2020 and the outlook remained mild, coupled with well-supplied and comfortable systems, prices continued to slip. With the bearish momentum already underway, the surge in the virus leading ultimately to lockdowns saw sharp drops in demand, especially after the first lockdown, with many businesses pausing activities and some, unfortunately, closing shop altogether, leading to volume being sold back into the market, which weighed on prices even further. The mild weather continued, with unseasonably warm temperatures persisting for much of the lockdown restrictions into the summer. The virus impacted other fundamental drivers as well, not just impacting demand for gas and power, but also impacting supply and market behaviour. So just moving on to the second slide, and we'll start by taking a look at oil in 2020. And as you'd expect, and in line with everything else, the market saw some significant drops in value. The chart below shows Brent crude, and as you can see, the contract took a huge hit as the first wave of lockdown restrictions came into force in March. As the virus began to spread in the United States, oil prices continued to be hit. For the most part in the States, the population is largely insular when it comes to travel. So the US driving season, which is between March and August, typically sees a predictable surge in refinery utilisation and is a big driver of oil prices. However, with restrictions in place across many states and people afraid to travel, the usual demand for oil refined products like gasoline wasn't there. This saw the WTI, which is the American crude oil contract, trading in negative territory, with producers paying to take the product off them with storage capacity at bursting point. With demand in the US being hit so heavily, the country has been seeking other markets to offload both oil and gas, which takes us on to LNG. When it comes to LNG, the UK and European markets have historically been the dumping ground of Middle Eastern and Russian gas. The UK receiving most of the larger QMax tankers from Qatar via the Mediterranean transport route. In recent years, and more notably in 2020, we've seen an increase in the number of US LNG tankers heading our way. This, in part, is due to the virus, as mentioned, but also due to a growing trend that actually started under the Obama administration, when the US began to eye up the European markets, which actually ended up with OPEC driving down the cost of oil and therefore gas in Europe with the TTF, the Title Transfer Facility, which is the largest gas index in Europe, is still benchmarked against oil futures. OPEC drove down the prices in an attempt to price the US out of the European market. When you fast forward to now, with oil prices recovering and disruption to supply in the Middle East, again in part due to the virus, we've seen an increase in the number of US tankers in UK waters. The knock-on from this is that not only are we competing with Europe for tanker deliveries, but we are also competing more heavily with Japan, which has been the traditional route for US LNG. UK gas prices are now having to match the JKM in order to encourage tanker flow in our direction, meaning as traders, we're paying more attention to supply and demand fundamentals in the Far East. Just moving on to the next slide. We'll start the 2020 review of power by looking at generation disruption, and more specifically French nuclear availability. Quite simply, the lockdown restrictions have also impacted generation, and in France this has led to reduced capacity at many of its nuclear power generators. As the UK, like it is with gas, competes directly with Europe for power via the interconnectors, reduced capacity in France leads to increased prices in the UK as we try to encourage power imports in our direction. During the latter parts of the summer months, this, along with industrial action at the French nuclear sites, also added support to our prices, both for power and for carbon. The chart below shows French nuclear availability through 2020 compared to the previous years, highlighting the shortfall, and you've got 2020 is in red at the bottom there. So as you can see, a lot lower than where it has been sort of the last few years. Also, liquidity has been an issue for the UK power market. It's been an issue for many years. It was the driving force behind the introduction of the Secure and Promote Market Making Obligation, or liquidity windows, which was suspended in November 2019. Since the suspension, liquidity has become worse with larger spreads between the bids and offers, and seasonal products further out on the curve often having no market at all. The virus would have had some impact on liquidity, as well as trading behaviour, with many now working from home. However, the liquidity began to dry up before the virus restrictions really got underway. For consumers and exporters alike, this has led to less favourable prices and more uncertainty over energy budgets. Taking a quick look at carbon, and despite downside elsewhere, we actually saw some bullishness for carbon in 2020. Speculative traders pulled away from their typical hunting grounds like oil and started to hedge in carbon markets. The influx of trading activity saw the contracts being supported, contrary to the bearish fundamentals with both warmer weather and lower demand. The contract really started to gain momentum at the back end of the year, still on a bullish trend today. The more ambitious EU carbon emissions reduction target of 55% compared to the previous 40% was voted through towards the end of the year, which saw carbon contracts in December reaching record highs, which they are continuing to test today. With COVID continuing to cause disruptions, we could see carbon following the wider equities markets and further support for speculators entering the market in the future. Having a quick look at renewables, the UK's increased independence on wind generation has highlighted frailties in the UK system. The volatility the forecasting, the reliance on wind generation brings, has seen National Grid reaching out more and more to the industrial and commercial sector to provide system relief. For example, demand-side response schemes where energy users can be paid to reduce their load requirements during times of system stress, whilst also selling unused capacity back to the within-day markets. It also highlights our dependence on power through our interconnection with Europe. In fact, the presence of the virus has perhaps accelerated the UK's energy system in line with what many perceive to be the future for the country anyway, by which I mean our increased reliance on renewables means day to day we can have larger price swings as forecasts fluctuate, especially on the within day and day ahead markets. This is something we were expecting to see maybe a few more years down the line, with many traders eyeing up the German market for inspiration as they are further ahead down their renewable journey than we are. However, with the presence of the virus stripping away demand and disrupting supply, we've seen greater swings and more volatility, hence bringing the markets closer to those renewable future conditions. After taking a look back at 2020's drivers, we can now look ahead to 2021 and perhaps some optimism for the marketplace. So just move on to the next slides. Just moving on to the next one. And on slide 4 here. On the whole, you'd be hard-pressed to find someone who isn't glad to see the back of 2020. As we step into the new year, there is some renewed optimism with vaccine production and global lockdown restrictions having some sort of positive impact on infection rates. If the vaccine is a success and we do see the back of the virus, what will emerge? What will we emerge into? Obviously, we don't have a crystal ball, but we can look ahead to the important market drivers and policy developments that could impact energy and businesses in 2021. The B word. It's been a while since it was the only thing on our news agenda. However, I'm going to talk about Brexit. The EU and UK in the dying seconds on Christmas Eve managed to reach a deal. But what does this mean for the energy sector? Well, initially, the new deal provides a framework for future trading between the EU and UK. As of the start of the year, the interconnectors are no longer governed by EU legislation, and a new framework will be developed to allow for efficient trading in the future. REMIT, which is the Regulation for Energy Market Integrity and Transparency, which is the regulation as traders all have to comply with, largely remains intact. However, UK participants who trade in the EU wholesale market will need to register with an EU regulatory authority, which is managed by ACER, which is the Energy Agency for the Corporation of Energy Regulators. So, for the most part, not a huge amount of change. The changes so far only really impact wholesale trading and governance. The interconnectors will continue to do what they do, and with harmonisation on the regulation, the pricing matrix will remain unchanged. The real impact of Brexit for the sector will be the financial impact it has on the industry and the currency. This was already hard to forecast, and with the real financial burden of the virus yet to materialise, it might be even harder to predict. Talking a little bit about recession, until October last year, and understandably, the UK economy was in recession. However, with some growth in Q3 2020, technically the recession is over. However, as already touched on, the real financial impact of coronavirus is yet to be seen. With the second wave of the virus deepening the negative impact, and with Q4 numbers yet to be published, the UK is heading towards a deeper double-dip recession than previously thought. The cost of the NHS and toll it's having on all of us is pretty plain to see, and we expect to see the financial repercussions from the furlough scheme affect us this year and possibly for years to come. Not to mention the slowdown in trade internally and externally. And I guess when you throw in Brexit for good measure, chances are that it's going to be some tough years ahead. But yeah, now that we've got some of that doom and gloom out of the way, we'll get back to the markets. As discussed in the 2020 review there, liquidity in UK markets has been sparse, a trend we saw develop after the removal of secure and promote liquidity windows. Without this kind of regulation, we would likely see this trend continue. With the volatility brought on by the virus, our reliance on renewable generation, and with Brexit, volatility looks here to stay. A sparse and volatile market can lead to big price swings and price moves dictated not by fundamentals, but rather by technicals and trading behaviour. This does, however, bring with it some opportunity for importers. So, for example, actually over the last couple of days, the front month power contracts have had sort of £4 or £5 spreads, and we haven't really seen anything trading beyond the sort of first couple of seasons, just highlighting those issues for liquidity. Moving on to the next slide. The UK government's energy white paper was released towards the end of 2020, and it highlights the new UK ETS, which is the Energy Trading System's ambitions to promote cost-effective decarbonisation, as well as encouraging growth in the sector. In many cases, the new scheme is more ambitious than the EU system being replaced. It sets out the Prime Minister's 10-point plan for a Green Deal, a green industrial revolution over the next decade, looking to cut 230 million tonnes of carbon from industry and transport whilst encouraging jobs and growth in the sector. Effectively, the white paper looks to put the UK at the forefront of an energy revolution with an added incentive to shine as we depart from the EU. The UK's ETS has replaced our participation in the equivalent EU scheme, and in line with the white paper, it looks to improve the country's climate ambitions and protect competition for UK businesses. For the immediate future, it will be business as usual, but as things develop, we may be paying more attention to this scheme and the economic dynamics of that market. As the UK becomes more reliant on renewables and with tighter power systems, National Grid are more heavily reliant on the industrial and commercial sector to manage their load more effectively. And Grid continue to offer incentives for doing so, so much we've already touched on, like demand-side response. If businesses can flex their consumption or generation based on intraday demand requirements and market drivers, they can also profit from selling and buying back volume. In a volatile marketplace, you have less control over the wholesale cost of your energy. However, you can control how you consume it. With non-commodities continuing and increasingly making up the larger parts of your bills, as Tom's been discussing, the ability to exert some control of these elements has become increasingly important. With the government's emphasis in the energy sector on cutting carbon and stimulating economic activity, this behaviour will become an increasingly important part of the energy conversation and will be a key driver of markets through 2021 and beyond. Thank you for listening. That's my bit on the markets there. I think we have some time for a couple of questions. And straight away, we have a question in regards to prices and where we see them going over the course of this year. I guess as always, unfortunately, we don't have a crystal ball, so we can't really sort of put a firm outlook on where we think things are going to go. However, we have started to see a change in the direction of prices, certainly compared to this time last year. So it's actually been a more bullish start to the year, really. I think the development of the COVID vaccine has certainly been a bullish driver, and people are expecting demand to pick up this year, and I think that's reflected by some of the sentiment in the oil markets, where I think Goldman Sachs the other day actually brought forward their prediction for sort of price to be around I think it was the $65 mark by the middle of the year rather than the end of the year. So that kind of sentiment around vaccine hopes and reduced lockdown restrictions is kind of starting to feed into markets like oil. So we are starting to see prices pick up. Similarly for the carbon market as well, especially off the back of these renewed targets in regards to reducing carbon emissions, and with expectation that businesses will get back to normal, we've started to see quite a bit of upside in the carbon market. So those two markets actually have had basically been on a bull trend ever since the year opened, really. So I guess the consensus is that prices will tick up this year, very, very high level. In fact, yesterday we had prices, especially on the front month, hit really crazy high levels. February was trading at sort of £86 for power. That was largely off the back of some cooler weather forecasts, but it just goes to show how volatile, how spiky things can be. So I think, some of those things we discussed, volatility is certainly playing its part, and I think people's expectation that COVID is going to get better in some way, shape or form is supporting markets. But Where the top is, I don't know, and often when things go up, there will eventually be some sell-off, and I think all it takes is some milder weather forecasts and perhaps deepening issues in the COVID thing just to take the edge off those prices again. But yeah, that sort of answers that one. I think we're sort of run out of time, I'm afraid, but if you do have any further feedback or questions, please contact us on the email address provided, just on screen there. And yeah, thank you very much for listening. And yeah, Happy New Year. Thanks.